Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Bert Brenner on the line. He's Director of Asset Allocation Strategy for People's United Wealth Management. Bert, how you doing on this Wednesday morning?
I'm great, Joel. Thanks. It's good to be speaking with you on this opening day of the Open Market Committee meetings.
Yeah, and the much awaited. Can you just give a little bit of your background and how you ended up managing $5.5 billion?
Well, let me first say I don't manage it single-handedly by any means, of course. Part of a team here of investment managers. And one of four committee chairs who report up to my boss was our chief investment officer, John Trainer. But how I ended up here was, I've been here at People's United Bank, heading the Asset Allocation Strategy Committee for the past 4 years. Prior to that, I had my own shop where I was doing something similar, developing asset allocation strategy for nonprofit organizations, something that that I saw and thought was desperately needed after spending a stint working in the nonprofit world. And before that, I was a banker in the more traditional sense. The treasurer of a large multi-state thrift institution before that, and another banking stint earlier than that. So I've been in the business for a while.
Okay, you've seen a lot of ups and downs in the markets, and well, now you have some recent volatility. You had a nice bull market, just churned higher. You had a few dips and corrections, really nothing major. But now we're having some major volatility here. Because of the volatility, you think people should kind of be backing away from equities in the market?
Joel, no, we don't think they should. And I'd like to put our recent volatility experience sort of in a historical perspective.
Okay.
And I laugh sometimes when people talk about volatility. Imagining that there will be no volatility in the market is imagining that the Pacific Ocean would become flat as glass. And I don't think we'd ever really expect that to happen. And what's more, if that happened in the capital markets, we'd really be scratching our heads wondering what's going on. There's always volatility in the sense, of course, prices and investors are always searching for price, if you will. But what we've just gone through over the course of the past couple of years, and particularly last year, was a period of very, very low volatility, below historical norms. And I think that was probably driven by the fact that we had pretty general consensus on what monetary policy was going to be throughout that period of time. And a fairly, I think, general consensus, too, about the direction of the economy. Not to say there weren't worries, but there was, I think, a general sense that it was plodding slowly upward, a slow expansion. Some nervousness every month when the labor market report would come out, but continuous confirmation of that. We're in a different world now, I think. We're in a world where investors are concerned about what the impact of China in particular is going to be on global economic growth. And at the same time, we're moving out of that flat or unchanged interest rate monetary policy, rather. And tomorrow may be the day when we get the first change in that. And although I'm not sure this has figured in as much in terms of market volatility, but we are facing some increased government dysfunction in Washington as we come up with having to deal with the budget and the debt ceiling again. But all in all, so we're looking forward, and we expect to see more market volatility or market volatility closer to what the historic average has been, which is above what we've experienced most recently. Perhaps not as high as what we've had, in the past month. But we still think we're going to be seeing higher volatility. And I think the key question for that is, of course, we see that volatility. It makes investors nervous, and particularly equity investors. And for an investor, they really need to be assessing or reassessing, if you will, their risk tolerance and what their overall objectives are. And if they can confirm that their risk tolerance is that they want to have, let's say, a 60 or 70% exposure to equities, I think they should stick with that and be prepared to deal with a bit more of a roller coaster ride.
All right, a big factor in the equation is China, and
Yeah.
a large economy, consuming a lot of our exports here. They seem to be slowing down. So at this point, I mean, do you think? I mean, are you basing this, rebound at China is, gonna rebound a little bit, or are you just thinking that, we do just fine even if China goes in the tank?
Well, I wouldn't say just fine. I think we definitely have to watch China, and I would advise the listeners to be a little bit careful about the representation of China being the world's second largest economy. If you look on it solely on a country basis, that's true. But in fact, the world's largest economy is Europe or the Eurozone. So between the Europe and the United States, we have larger economies than China. So put that in a little bit of perspective. We've been mistrustful of the numbers that China has reported for the past for some time actually. They have strong incentives, of course, both to achieve those targets, but also to give the appearance that they're achieving those targets. So there's. I was in Shanghai a number of years ago, and there's a policy in Shanghai that when the temperature rises above 40 degrees centigrade, and if you do the math, that's well over 100 degrees. If it rises above 40 degrees centigrade, then workers are sent home. Well, the interesting thing is there's an official thermometer someplace in Shanghai, and I don't know where that is. And although the temperature in other places would frequently be recorded as above 40, it was rarely above 40 on the official thermometer. So I think some of the statistics that come out of China are sort of, if you will, managed in the same way. But to the substance of the matter, we do think the manufacturing sector in China is slowing. Even the official numbers have shown that exports have been, declined on a year-over-year basis. And I think this really roiled the market when those numbers came out in August. From our perspective, the challenging thing is to understand what the direct versus the indirect impact of a slower or more slowly growing Chinese economy will be on our economy and on the world. The direct impact is not likely to be large. China is our fourth largest destination country in terms of exports, but that's not very large. They consume about 7% of our exports. Europe also, it's not a particularly strong export destination for Europe. Hear a lot of talk about a lot of German exports going there, but on balance, and for the entire Eurozone, it's not real large. In fact, we are much more important to China than China is to us, and by us I mean both the economy, Eurozone economy, and the United States economy. So insofar as both Europe and the United States are recovering or growing, that was going to provide some support for the Chinese economy. The concern, though, is the indirect effect, and there's no question that there are other parts of the world, emerging market economies, and the immediate regional area around China, where China is much more important to them. China is the major export destination for Australia. It's second for Japan, tops for New Zealand. So if their economy slows, we could see those countries be impacted. And, of course, that will have a ripple effect around the world and naturally could affect us then, too.
So let's talk.
Also, yeah, so.
No, let's move on here. Let's talk about, the possible rate increase tomorrow. Now, you believe a rate is in order and will come, if not this month, by the end of the year. And you think it's going to have a positive impact on the economy? Or, I mean, overall, it kind of has a negative impact if it increased borrowing costs, for old loans tied to the prime. So, give us your scenario here for the U.S. markets if rates do go up.
Well, Joel, I'm surprised. I haven't seen any commentators actually ask that question about what the impact will be in the transmission through to borrowing costs. So the Fed will have to be fairly confident that the economy is strong enough to sustain some transfer of wealth, if you will. It actually will be that. Profits from other sectors of the economy to the banking sector, that will effectively be what will happen. And the messaging is going to be key here. I don't think it's so much the actual rate change, whether it happens, or the magnitude of the rate change, but I think it'll be the messaging from the Fed that will be absolutely most critical. And I think that the messaging, if done well, will actually be supportive of the capital markets, of the stock market in particular. I think when investors understand that this is an indication of strength and confidence in the U.S. economy, that will actually support the stock market. Bonds, a different story, but I think it'll be good for the stock market.
All right, so I don't know if you could talk individual stocks or not, but we could just go sectors here. And obviously, the financials. You think that they're going to get if the rates do go up, it's going to be a boost for your J.P. Morgans, your Morgan Stanleys, your big banks. What do you think? What sectors would benefit from a rate hike?
Well, I think that in terms of the fundamentals, we could see that the financial sector would benefit for the exact reason that the revenue stream is going to be increased with increasing rates. Two factors, of course, if the prime goes up, that's going to increase the loan revenue. Financial institutions, and particularly the banking sector here primarily, they've been really squeezed with narrower margins, low interest rates, and have hurt everyone, but they have hurt the banking industry because of the fact they haven't been able to maintain the spread between the interest rates they charge and the interest rates they pay, despite the fact, as we all know, as consumers, they've been paying virtually nothing. So there'll be some relief there. In terms of other impacts, and I don't really have the sort of fundamental analysis to back this up, although some historical analysis would lend one to believe that the sectors that have done the best following the start of an initial rate hike, looking out 12 months, have been technology, healthcare. And of course, those have been pretty strong sectors in our in the stock market without a rate hike. So I think we would look to see those sectors performing well following the start of a rate hike.
Bert, we've only got a couple minutes left here with you. Can you just share with us some of your general capital market expectations?
Oh yeah, hi Brianna. Sure, and this is one of our major concerns actually for our clients. We're coming out of a period of time over the course of the past 6 years where investors on a compound rate have realized returns of nearly 19% in the stock market, and by the stock market referring to the S&P 500. And not everyone has enjoyed that, though, because, of course, people have been slow. As some commentators have said, this has been a rally that people have loved to hate. So for people who were slow to get back into equities, they might not have had this the benefit of this ride. And by the way, that's all the way through the end of August, too. So it's taking into account the sell-off we've had in August. But we're not going to see, we think it's very unlikely that we're going to see capital market returns, stock returns, anywhere near that over the next 5 to 10 years. Our return expectations for bonds, of course, are also well below historical averages. We think that a balanced account going forward, it's very likely that investor is going to be faced with a return on a balanced account on the range of between 5 to 6%. When I look at some of our clients, we have some foundations, for example, and charitable foundations have a mandate to spend 5% of their principal every year. When we're looking at capital market returns that are not going to be much above 5%, foundations are going to be really challenged to maintain their purchasing power and to support their missions going forward. On a more personal basis, for us individual investors, those of us who are counting on the sort of 7 or 8, 9% returns, perhaps, to grow our retirement funds for the future, we're not likely going to see that over the next 5 to 10 years. So our returns are going to be more modest. And I think the upshot of that is that people that we're gonna need to be saving more in order to provide the degree of comfort and income that we want in our retirement years. And I would really caution investors and listeners not to go shopping around for someone who's going to tell them a different story. That's dangerous. There's no such thing as a free lunch, and the best thing to do is to make one's plans for the future with with modest expectations, and we think that having returns, equity returns on the order of 6% and bond returns on the order of 3 to 4% are what people are likely to see over the next 5 to 10 years.
Great advice from Bert Brenner. He's the Director of Asset Allocation Strategy for People's United Wealth Management. Bert, thank you so much for joining us on the show today. We would love to have you back again soon.
Great, Brianna. I really enjoyed it. It was my pleasure. Thank you. And Joel, too.